Welcome to Market Meridian Finance. I am Eric. Today, the global energy market is facing a crisis not seen in decades. Brent crude oil has broken decisively above $103 per barrel, fueled by explosive rumors that the Strait of Hormuz could face a full or partial closure in the coming days. This waterway represents the single most important choke point for global oil supplies, carrying roughly 20 to 25% of all seaborne traded oil. Every single day, nearly 20 million barrels of oil pass through this narrow channel, destined for Europe, Asia, and the Americas. What began as regional tensions has quickly escalated into a systemic threat to global energy security, and markets are now pricing in an unprecedented level of risk. Over the past week, crude oil has staged one of its sharpest rallies in recent history. From levels near $78 just a month ago, Brent has surged more than 30%, breaking through key technical levels and forcing institutional investors to reprice their entire outlook for commodities. The driving force is no longer just production policy from OPEC+ or demand trends from major economies. This is a pure geopolitical supply shock, the kind that can send prices soaring in hours rather than weeks. Traders, hedge funds, and institutional buyers are pouring capital into oil futures and options, betting that even a temporary disruption could create a supply gap that the world cannot easily fill. The Strait of Hormuz is not just any shipping lane. It is the jugular vein of the global oil trade. Saudi Arabia, Iraq, Kuwait, and the United Arab Emirates all rely on this channel to export the majority of their crude production. Any closure, even for a matter of days, would immediately remove millions of barrels per day from the market. Tanker traffic has already slowed dramatically, with shipping companies diverting vessels, halting bookings, and raising insurance costs to record highs. For energy markets already operating with minimal spare capacity and declining inventories, this is the worst possible scenario. In a landmark report that has sent shockwaves across Wall Street, Bank of America's Global Commodity Strategy team has now warned that oil prices could surge to $200 per barrel if the Strait of Hormuz remains closed for an extended period. This is not a sensationalized prediction, it is a base case scenario for a prolonged disruption. The bank highlighted three critical factors that make $200 oil plausible: near record low spare capacity across OPEC+, falling commercial inventories in the world's largest economies, and inelastic global demand that cannot quickly adjust to higher prices. In simple terms, there is no extra oil waiting to replace lost supplies, and the world still needs energy regardless of cost. Spare capacity among major oil producers has fallen to levels not seen since the 1990s. OPEC+ is already producing near its practical limits, with only a small buffer of roughly 2 million barrels per day available in an emergency. That buffer is negligible when faced with a potential disruption of 8 million barrels per day or more from the Strait of Hormuz. Even if every available spare barrel were released onto the market, it would not come close to filling the gap. Commercial inventories in the United States, Europe, and Japan have been declining for 5 consecutive months, falling well below their 5-year averages. Low inventories mean there is no safety net to absorb supply shocks. When stocks are low, even small disruptions lead to extreme price volatility. The $200 oil forecast from Bank of America has forced every major bank on Wall Street to revise their price targets upward. Goldman Sachs now sees a worst-case scenario of $145 per barrel. Wood Mackenzie warns that triple-digit oil is here to stay for the rest of 2026. UBS predicts prices above $150 if shipping disruptions continue through the second quarter. What was once unthinkable is now becoming a mainstream expectation. The market has moved from pricing in a small risk premium to fully pricing in extended supply fears. But this oil rally is not just affecting energy markets. It is spilling over into the real economy, starting with the U.S. diesel market. For the first time since 2022, average retail diesel prices in the United States have broken above $5 per gallon. Diesel is the lifeblood of the global economy. It powers trucks, trains, ships, farming equipment, construction machinery, and manufacturing operations. Unlike gasoline, which primarily affects consumers, diesel impacts every stage of the supply chain. Higher diesel costs translate immediately to higher food prices, higher shipping costs, higher construction costs, and higher prices for nearly every physical good sold in stores. This surge in diesel prices has triggered what economists are calling a second wave of inflation. For months, inflation in the United States and across developed economies had been cooling. The Federal Reserve had been preparing to cut interest rates, hoping to support economic growth while inflation trended lower. Those plans are now in serious doubt. Every $10 increase in crude oil adds roughly 0.2 percentage points to US CPI. If oil remains above $100, US inflation could rebound from around 2.4% back above 3.5%, reigniting the inflation nightmare that dominated 2022. The Fed now faces an impossible dilemma. Cutting rates into an energy-driven inflation surge could de-anchor inflation expectations and lead to a wage price spiral that is difficult to break. Keeping rates higher for longer, or even hiking again, would raise borrowing costs for consumers, businesses, and the government, significantly increasing the risk of a recession. Stagflation, the toxic combination of high inflation and slow growth, has moved from a remote risk to a base case scenario for many economists. The global market reaction has been swift and severe. Energy stocks have become the best performing sector, with major oil producers like ExxonMobil, Chevron, Shell, and Saudi Aramco hitting all-time highs. Oilfield services companies, refiners, and pipeline operators are also surging. On the flip side, high-growth technology stocks are under pressure as rising inflation expectations push bond yields higher. Higher yields reduce the present value of future earnings, hitting tech and speculative assets hardest. The Nasdaq has fallen more than 3% in a week, while the Dow Jones, which holds more industrial and energy names, has held up far better. Internationally, the impact is even more dramatic. Europe, which is heavily reliant on oil and natural gas imports from the Middle East, faces renewed energy inflation and a potential return of the cost of living crisis. Asia's major manufacturing economies, Japan, South Korea, China, and India, are seeing their import bills balloon, putting pressure on their currencies and current account balances. Emerging markets that rely heavily on energy imports are experiencing currency collapses, capital outflows, and rising inflation. The US dollar has strengthened dramatically as investors seek safety amid global uncertainty. Since the Hormuz fears escalated, the dollar index has risen to a 2-month high, outpacing the euro, Japanese yen, British pound, and nearly every emerging market currency. A stronger dollar makes energy even more expensive for non-US buyers, creating a vicious cycle for global growth. Commodity markets beyond oil are also feeling the heat. Petroleum-based products like plastics, fertilizers, chemicals, and synthetic materials are all surging in price. Agricultural commodities are rising as fuel and transportation costs jump. Precious metals like gold and silver are catching a bid as investors seek inflation hedges and safe havens. The entire commodity complex is being repriced based on the new reality of higher energy costs. Many investors are asking whether this oil rally can be stopped. The most obvious solution would be a de-escalation of tensions in the Middle East and a full reopening of the Strait of Hormuz. If shipping returns to normal in the coming days, much of the risk premium could evaporate, and oil could fall back toward $80 or $90 per barrel. However, if tensions persist or escalate further, prices will continue to climb. Another potential relief valve is the release of Strategic Petroleum Reserves, or SPRs. The International Energy Agency has already signaled a coordinated release from member nations. The United States could release additional barrels from its SPR, while Europe, Japan, and South Korea could follow suit. While SPR releases can calm markets in the short term, they do not solve the underlying problem of a physical supply shortage. SPRs are finite, and repeated releases leave countries less prepared for future disruptions. OPEC Plus also faces intense pressure to increase production. However, the group has shown little willingness to abandon its production cuts prematurely. Many OPEC Plus members prefer higher prices, and their ability to raise output significantly is limited by low spare capacity. Even if OPEC Plus wanted to flood the market, it simply does not have enough oil available to offset a major disruption in the Strait of Hormuz. Longer term, this crisis is accelerating the push for energy independence and diversification. countries are rethinking their reliance on Middle Eastern oil, investing more in domestic production, renewable energy, nuclear power, and alternative fuels. Shipping routes are being re-evaluated to reduce vulnerability to choke points. Energy security is once again becoming a top political and economic priority across the globe. For traders and investors, the message is clear: volatility is here to stay. Oil prices will remain highly sensitive to every headline coming out of the Middle East. Every tweet, every official statement, every report of tanker movements will move markets. Those who can navigate the volatility stand to profit, while those caught off guard face significant losses. Looking ahead, 3 factors will determine the future of oil prices. First, the status of shipping through the Strait of Hormuz. Second, the scale and duration of any supply disruption. Third, the response from governments, central banks, and energy producers. A short, contained disruption will lead to a temporary spike. A prolonged disruption will change the global economy forever. At Market Meridian Finance, we will continue to bring you real-time analysis, breaking news, and institutional insights as this crisis unfolds. The world is now facing an energy shock that will reshape markets, politics, and daily life for years to come. $103 oil is just the beginning.